In a Financial Times opinion piece, famed banking and finance attorney Rodgin Cohen weighing in on the Business Roundtable's letter redefining a corporation. Cohen says he supports the BRT's decision, and he's here now to explain why. Rodgin, of course, is the senior chairman of Sullivan Cromwell and has been, dare I say, the consigliere to many a CEO across the world. There's been a lot of debate about this, Rodgin, in terms of whether this is PR spin, whether this is real. We've talked to Secretary Mnuchin, who said he wouldn't have signed it. Steve Schwartzman at Blackstone didn't sign it. Why do you think this is the best way forward?
Well, let me start with the view that a corporation should consider the interests of non-shareholder constituencies precisely because it advances shareholder value. I mean, what shareholder would not want its corporation to be seen as the employer of choice, or to be seen as a good public citizen, or to have a strong compliance record? And really, this is not some radical new theory. For decades, corporations have made charitable contributions, and they've encouraged their people to participate in civic and philanthropic organizations.
But then the question is, the day that this Business Roundtable statement came out, there was this idea that this was a sea change in the way business operated. Then all of a sudden, there were other people who said, no, actually, this is not a real change at all. This is just codifying what we already do. So which is it?
I think it is definitely the latter.
Well, then if it's the latter, what was the need to...
And just listening to what you said, Raj, if you take the inverse of what you said, that what shareholder wouldn't want the CEO doing these things, you take it the other way. What CEO wouldn't realize that doing those things is all part of enhancing shareholder value anyway? So,
I think every CEO in today's world should realize that.
You know what?
I'm not sure everyone does.
The downside, Raj, was that I think it feeds into the narrative that corporate greed is bad. It feeds into the narrative that the things that people like Bernie Sanders and Elizabeth Warren are positing, that it almost is an acknowledgement or a concession that you're right. We've been bad actors in the past because of this shareholder focus, and we're going to change our ways.
I would really respectfully suggest that making a statement such as this does not suggest that what has happened in the past is bad and what we're now going to do is reform. I think it's appropriate to make a clear statement.
But it seems you seem to just suggest that there are some CEOs that you don't think were following this path.
That is true. I think some were not.
And you think that this statement, therefore, gives them license to do so in a way that they wouldn't otherwise? What do you think the impact of this is?
I think the impact is that shareholders will be going to companies and going to CEOs and saying, we benefit if you promote the public interest.
But go ahead.
The two questions, I had like a question about the past and a question about the future. And it was, do you think that the shareholder-centric focus in the past resulted in or enabled bad behavior? And do you think that by purely stating this, giving it lip service, would actually change behavior in the future and there wouldn't be any bad behavior?
We're never going to eliminate bad behavior by definition.
So we should keep we should keep Dodd-Frank. We should keep some of the regulations. We can't just put it in the CEO's court now that he's got these BRT suggestions. I think we still need to watch, don't you?
We definitely need to watch, and there...
You think it's resulted in bad behavior in the past? The shareholder focus, the greed, or whatever?
I think it has given, I'll use your words, which are the right words, it's given license.
It has given license. So the shareholder focus has resulted in something in 2008 that you dealt with.
If it's shareholder focused to the exclusion of everything else, yes.
So it's interesting because a lot of people looked at this as a rebuke of Milton Friedman. And if you go and look at his words, there's no question that the headlines and a lot of the rhetoric that he spoke about, what was picked up was this idea that profits over just about anything else would suffice, or more than suffice. But if you really get into some of his language, he also gets into this idea that you might have to give charity. And you might have to think about constituents, and all of that is wrapped up in the profit piece.
Well, I think you are exactly right. And to put it in the following words, I think shareholders and non-shareholders are more symbiotic than they are divisive.
Right. As an attorney, this accomplishes quite a bit for corporations too, and I've had that point made to me in terms of this fiduciary responsibility. It's good to have this stuff stated overtly.
Well, except for the fact that I'll tell you, Jay Clayton, and in some states, this is a state's issue in terms of fiduciary duty. There could ultimately be lawsuits brought by shareholders, and
because you're supposed to be fiduciary responsibility.
And what is a fiduciary responsibility? You know, how do you define fiduciary responsibility, right?
Yes, and you've got 50 states, and there are 6 states only which actually have a shareholder primacy rule of law. The 44 states have constituency statutes, and interestingly enough, there are about half the states which have public benefit statutes. Not surprisingly, there's no S&P 500 corporation.
The CEO saying what recently someone said on GMA, I didn't do anything wrong, but I promise I won't do it anymore.
What's Delaware?
Delaware is shareholder primacy.
Shareholder primacy.